This is Barry Zalma on insurance. Today I'd like to talk about fraud in a catastrophe. According to the Coalition Against Insurance Fraud and general experience, natural disasters are always followed by fraud. The sheer size of the cleanup created by Hurricane Katrina, for example, and other hurricanes since 2005, has ignited the biggest glut of litigation and insurance fraud attempts in the history of U.S. disasters. Lieutenant Alan Carpenter, the head of the Louisiana State Police Insurance Fraud Unit, which is the focal point for suspicious claims presented in the state, said, quote, "In a normal catastrophe, about 11% of claims are fraudulent. I think the percentage of fraudulent claims will be the same, but it's just such a large catastrophe," speaking about Katrina, "that the numbers will be greater. What's going to be different is the wide extent of the flood and the overall number of fraudulent claims. With so much destruction, large numbers of broke, homeless, and usually honest victims might feel they have no other means of rebuilding shattered lives than by cheating on their insurance claims. The risk is small. The profit potential is great, because insurers will have a difficult time verifying claims where homes were totally destroyed. Entire neighborhoods were flattened, with homes often reduced to piles of broken boards or empty concrete slabs. Insurers, after every catastrophe, especially one as widespread as Katrina or as the wildfires in the West, are charged with intense pressure to help policyholders quickly by governmental authorities and the press. Insurers know that many exaggerated, false, or fraudulent claims, especially smaller ones, will slip through the system. In November of 2011, Robert Lee Spires, a West Alabama man, pleaded guilty to fraudulently claiming disaster benefits following the April 27 tornadoes in Alabama. Spires entered his plea before U.S. District Judge L. Scott Kugler to 2 counts of attempted wire fraud in connection with a scheme to defraud the Federal Emergency Management Agency. Prosecutors claimed, and his guilty plea established, that Spires received $1,114 for rental assistance and $471 for personal property assistance from FEMA, the Federal Emergency Management Agency, after falsely claiming that he was renting a house in Tuscaloosa when it was damaged by a tornado. He was not eligible for the assistance because he did not live at that address and did not own any property there. Insurers discovered that they paid the following false claims after Katrina and after almost every other catastrophe, whether a wildfire in California or a tornado in Alabama or a hurricane in Louisiana. 1. Homeowners or renters who claim they lost expensive jewelry, stereos, TVs, or other luxury goods they never owned. 2. Business owners who claim they lost more inventory or equipment than they owned. 3. Insureds who inflated claims for lost business and income. 4. False claims for lost cars, minivans, or SUVs that disappeared in the flooding. 5. Many Gulf residents lacked flood insurance. Their homeowners' policies generally didn't cover flood losses and wind damage, so people set fire to their homes and made illicit fire claims. More than a dozen suspicious home fires broke out in houses without electricity or gas service around New Orleans. Many claimed that their houses were destroyed by wind before the floods. Some swindlers impersonated real claimants to try and steal their insurance settlement checks. Some public insurance adjusters charged homeowners a large upfront fee, then disappeared without handling the claim. Some public insurance adjusters taught homeowners how to file bogus claims in exchange for a cut of the insurance money. Some public insurance adjusters referred victims to crooked contractors who bribed adjusters for referrals. Unlicensed or inexperienced contractors performed shoddy work, but charged a victim's insurer for quality work. Some residents claimed on life insurance proceeds falsely by claiming they lost a loved one whose body was never found, and outsiders claimed a spouse disappeared while visiting the Gulf region. None of these claims were true, but they were paid because the insurers were afraid that they would be called racists or just mean when they refused to pay claims to people who suffered from such a horrible catastrophe. In addition to catastrophe frauds, which seem to grow like Topsy, there are other kinds of criminal acts that are related to insurance. For example, where a yacht policy contained a provision excluding coverage for any loss, damage, or liability willfully, intentionally, or criminally caused or incurred by an insured person, the First Circuit Court of Appeals found no coverage where the operator of the boat or vessel or yacht was convicted of criminal negligence that resulted in the death of a passenger. The court based its decision on the fact that even in the absence of a statutory requirement of intent, under New Hampshire state law, a person cannot be convicted of a crime, including a misdemeanor, without proof that the unlawful act was accompanied by a culpable mental state. This is State v. Goodwin, a 1996 decision of the New Hampshire Supreme Court. Negligent operation of a watercraft in the absence of the requisite culpable mental state could not be a crime and would not trigger the exclusion provision. Hence, criminal negligence differs from civil negligence under New Hampshire law in important ways, and the yacht policy provides meaningful coverage for loss or liability incurred through negligence other than the criminal act. On the other hand, consider Rex K. DeGeorge, a lawyer who was charged with fraud and unsuccessfully appealed his conviction and sentence following a month-long jury trial for conspiracy, mail fraud, wire fraud, and perjury. The government proved to the trier of fact that DeGeorge participated in a scheme to defraud an insurer by purchasing a yacht, inflating its value through a series of sham transactions, obtaining insurance on the yacht at the inflated value, scuttling it off the coast of Italy, and attempting to collect the insurance proceeds in part by lying about the cause of the sinking during civil litigation with the yacht's insurer. That insurer used one of the most effective and seldom used tool to defeat insurance fraud. It used the equitable remedy of rescission. Because insurers have little stomach to fight insurance fraud, they encourage more and more fraud. The United States Court of Appeal for the Ninth Circuit dealing with an alleged insurance fraud and an insurer's request for a finding that its policy should be rescinded from its inception, stated that the history of claims presented by then California lawyer Rex DeGeorge was sufficient to support rescission. Now, I personally knew Rex and had dealt with him in several prior claims where he represented people who had committed fraud. And it was well known that Mr. DeGeorge was less than an honorable lawyer. And one of my clients had asked to be his insurer, sought my opinion and that of an adjuster with whom I worked, and we advised them to never insure Mr. DeGeorge against the loss of his property. And so they issued a quick 10-day notice of cancellation and posted an investigator from the adjusting firm in front of DeGeorge's house for the 10 days to make sure there were no losses. So when the decision was made in the trial court that DeGeorge's policy for the loss of his yacht should be rescinded, I called the lawyers who represented his insurer to ask the name of the, quote, lawyer witness, which was the only thing listed in the news report, and asked them if the lawyer whose policy was being rescinded's name was Rex. And they admitted it was and were quite surprised that I knew him. Regardless, the history presented to the court showed that Rex DeGeorge had begun losing yachts almost 3 decades ago. He had been the owner of a 43-foot yacht called Titania. In 1970, he was interested in selling it, and when a couple of purported Peruvian coffee merchants showed an interest in the yacht, DeGeorge arranged to take them for an overnight test run. That night, the coffee merchants drugged him and his companion. DeGeorge and his companion, still feeling ill the next morning, escaped and sailed 35 miles back to shore in the yacht's dinghy, while the coffee merchants remained on board the vessel. 5 days later, DeGeorge reported the theft to the police. The Titania and the Peruvian coffee merchant bandits were never seen again. The Titania had been insured by the Hartford Insurance Company. After DeGeorge threatened litigation for bad faith denial of his claim, Hartford paid him $43,000, the full policy value. He bought another vessel, this time a 57-foot racing yacht called the Epinicia. 6 years after DeGeorge lost the Titania, he was sailing the Epinicia off the coast of Italy, and the two men were sailing along on a starless, moonless night when, about midnight, they suddenly struck a low-profile dark object that was not visible, and the ship sunk. DeGeorge had insurance on the yacht and filed a claim with Lloyd's, who originally declined to pay the claim, but after he threatened litigation, they changed their position and paid him $194,000 for the yacht. In 1983, DeGeorge was handling a lawsuit on behalf of a client, and the suit involved business deal potentially worth billions. According to DeGeorge, the parties opposing the suit had decided to pursue a rather unorthodox litigation strategy. They attempted to kill him. These parties had previously suggested they might in fact nail George's kneecaps to the floor. Although DeGeorge didn't lose his kneecaps, an attempt was made that year to kill him when he and his wife were sailing off the California coast. This time, DeGeorge lost a 47-foot yacht insured for $245,000. In 1970, a Rolex watch was stolen, and he collected $1,150. Personal items and jewelry worth $2,000 were taken from an unattended taxicab in Sydney, Australia. A 1971 baggage stolen from unattended more than a vehicle in Barcelona. A 1974 missing Jensen Healey automobile, a 1981 baggage loss, a 1990 baggage loss, a 1991 baggage loss, a 1992 painting and personal property claim stolen from his house that included $700,000 in payment from the insurer who took over the coverage from the Lloyd's insurer who canceled with 10 days' notice on our advice. And in 1993, other losses from 1992 undisclosed thefts. DeGeorge's bad luck extended beyond the loss of mere property. He also filed 29 insurance disability claims from 1976 to 1990. Regardless of his rather incredible background, the Ninth Circuit turned to the facts giving rise to the present case, the total loss of his fourth yacht, and in June 1992, DeGeorge contracted for the construction of a 76-foot motor launch, the Principi de Pictor, from Azimut S.p.A., an Italian firm, for the purchase price of $1.9 million. While the Principe was still under construction, DeGeorge assigned his end of the construction contract to Continental Pictures, a Panamanian corporation apparently located in Switzerland. Although Continental allegedly bought DeGeorge's contract for $3.6 million, Continental never paid anyone any money. In fact, after the contract was assigned to Continental, Azimut looked only to DeGeorge for progress payments. Continental then sold the Principe to Polaris Pictures for $3.62 million. Polaris had been formed by DeGeorge. The district court found this agreement was entered into for the purpose of distancing DeGeorge on paper from Polaris's acquisition of the yacht. After Polaris bought the yacht from Continental, Polaris allegedly entered in an agreement with Jacob Wiseman, supposedly a client of DeGeorge. Wiseman agreed to pay a 90% interest in Principe for $3.62 million. Polaris continued its ownership until the yacht eventually sunk. Unfortunately for Mr. DeGeorge, the Italian Coast Guard happened by and recovered the yacht and dragged it in by towing it into port, where the ill-fated Principe sank again while at the dock. When it was raised 3 days later, it was a total loss and had a large, totally square hole in the hull. The district court, finding the entire claim to be fraudulent based upon fraudulent representations to the underwriters, rescinded the policy, and you can read the full case at Cigna Property versus Polaris Corp., a Ninth Circuit decision from 1998. This video was adapted from my book, Zalma on Insurance Claims, Part 109, Second Edition, which is a ninth part of the 10-part treatise, Zalma on Insurance Claims, all of which are available as Kindle books and as paperbacks from Amazon.com. If you found this video to be interesting, please refer it to your colleagues. It's free. And please also subscribe to my YouTube channel, my Rumble channel, my blog, and my Substack blog postings. Thank you for your attention.